studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
One of the most important payroll concepts for both business owners and tax preparers is understanding the difference between gross pay and net pay. Many payroll planning mistakes occur because people focus only on the gross salary amount and forget to consider what the employee will actually receive after deductions. This slide illustrates that difference. On the left side, we see gross pay. Gross pay represents the total compensation earned before any deductions are applied. In this example, the employee has a gross salary of $10,000. This is the amount that appears in payroll calculations before taxes, CPP contributions, and other deductions are considered. Gross pay is important because it determines the employee's earnings and forms the basis for payroll calculations. However, gross pay is not the amount that ends up in the employee's bank account. That is where the middle section of the slide becomes important. Between gross pay and net pay are payroll deductions. Think of these deductions as checkpoints that the payroll amount passes through before it reaches the employee. Income tax is deducted. CPP contributions are deducted. There may also be employment insurance premiums, benefits, or other payroll-related deductions depending on the situation. Each deduction reduces the amount of money that the employee ultimately receives. This is why looking only at gross pay can create misunderstandings. A gross salary may appear attractive on paper, but the actual take-home amount can be significantly lower once payroll deductions are applied. Now look at the right side of the slide. This is net pay. Net pay is the amount that actually reaches the employee. It is the amount deposited into the employee's bank account. It is the amount available for spending, saving, investing, or paying personal expenses. In other words, net pay is the real-world result of the payroll calculation. This distinction is extremely important during compensation planning. A business owner may say, "I want to receive $10,000. But a professional tax preparer immediately asks an additional question. Do you mean $10,000 of gross pay or $10,000 of net pay? Those are two very different outcomes. A $10,000 gross salary will result in a lower net payment after deductions. If the objective is to receive a specific amount of take-home pay, the gross salary may need to be adjusted accordingly. That is why the message at the bottom of the slide is so important. Employees spend net pay, not gross pay. Nobody uses gross pay to pay bills. Nobody uses gross pay to make purchases. The money that matters from a cash flow perspective is the net amount that actually arrives in the bank account. The key lesson from this slide is simple. Gross pay is the starting point. Net pay is the destination. Professional payroll planning requires understanding both. And before finalizing compensation decisions, practitioners should always consider how payroll deductions will affect the amount that the employee ultimately receives. That focus on net pay helps prevent misunderstandings, improves planning accuracy, and ensures that compensation expectations align with real-world payroll results. This slide highlights one of the most common payroll planning mistakes made by both business owners and inexperienced practitioners. The mistake is simple. They focus entirely on gross pay and fail to consider what happens after payroll deductions are applied. At the center of the slide, we see a business owner looking at a pay stub and wondering why the paycheck is lower than expected. This situation occurs more often than many people realize. The compensation plan looked correct when discussing gross salary, but once payroll deductions were applied, the actual amount received was very different from what the individual expected. Let's look at the specific problems shown around the slide. The first issue is unexpected net pay. An employee may hear that they are receiving a $10,000 salary payment and assume that $10,000 will arrive in their bank account. But payroll deductions reduce the amount received. The result is a lower net payment than expected. This often surprises individuals who focus only on the gross amount. The second problem is cash flow misunderstanding. Many people make spending decisions based on the gross salary number rather than the net amount they will actually receive. Budgets are created, expenses are planned, financial commitments are made, and then the actual deposit arrives at a lower amount. This can create cash flow challenges and financial stress. The third issue involves CPP deductions. Many owner-managers and family members underestimate the impact that CPP contributions can have on take-home pay. CPP deductions are an important part of payroll calculations, but they reduce the net amount available for spending. If this reduction is not considered in advance, the final payroll result may come as a surprise. The fourth problem is tax withholding shock. Income tax deductions can be substantial, particularly when larger salaries or bonuses are paid. A compensation plan that looks attractive at the gross level may look very different once tax withholdings are applied. Again, the issue is not that the deductions are incorrect. The issue is that they were not considered during the planning process. The fifth consequence is client complaints. This is a situation many practitioners encounter. The client receives a paycheck and immediately asks, "Why is my paycheck lower than expected?" In many cases, the payroll calculations are completely correct. The problem is that expectations were based on gross pay rather than net pay. Finally, there are payroll planning errors. When compensation decisions are made without understanding the net pay impact, the planning process becomes incomplete. The salary may be correct from a tax perspective, but it may not achieve the intended cash flow objective. This is why professional payroll planning always goes beyond gross salary calculations. Notice the important message at the bottom of the slide. Gross pay may look right while net pay tells a different story. That statement summarizes the entire lesson. A payroll strategy should not be evaluated solely by looking at the gross amount. It should also be evaluated based on what the employee actually receives after deductions. The key lesson from this slide is simple. Gross pay is only part of the picture. Net pay is the real-world outcome. Professional payroll planning requires understanding both. By reviewing net pay before payroll is finalized, practitioners can avoid surprises, improve client communication, and ensure that compensation plans achieve the results that were originally intended. This slide compares two very different approaches to payroll planning. At first glance, both approaches may appear to be trying to achieve the same goal. Both are focused on compensation. Both involve payroll decisions, and both affect how much money an employee receives. However, the quality of the results is dramatically different. Let's begin with the approach shown on the left side of the slide. This is the gross pay only approach. In this method, the individual focuses almost entirely on the gross salary amount. The thought process is simple. I want to pay myself $10,000. The problem is that the analysis stops there. No attention is given to payroll deductions. No estimate of net pay is prepared. No consideration is given to tax withholdings, CPP contributions, or other payroll deductions. As a result, the individual assumes that the final outcome will be close to the gross salary amount. Then payroll is processed. Deductions are applied, and the actual take-home pay is much lower than expected. This often leads to confusion and disappointment. The payroll calculations may be completely correct, but the expectations were based on incomplete information. Notice the challenges listed on the left side. The focus remains only on gross salary. Payroll deductions are ignored. Take-home pay is assumed rather than calculated. Payroll results become a surprise. and client dissatisfaction becomes more likely. This is why relying solely on gross pay can create problems. Now let's look at the professional approach shown on the right side of the slide. The process begins differently. Instead of focusing only on gross salary, the professional calculates net pay before finalizing the compensation decision. This changes everything. Tax deductions are reviewed. CPP contributions are considered. Payroll calculations are performed in advance, and the expected take-home pay is estimated before payroll is run. Notice the workflow shown in the center of the slide. The process begins with gross pay. Payroll calculations are then applied. Those calculations produce a net pay estimate, and only after reviewing that estimate is the final compensation decision made. This is how professional payroll planning works. Rather than guessing the outcome, the practitioner calculates the outcome. The benefits are significant. Net pay is understood in advance. Tax impacts are visible. CPP deductions are anticipated. Expectations become realistic. Payroll surprises are reduced, and compensation planning becomes much more effective. The comparison banner at the bottom summarizes the difference perfectly. The gross pay only approach says, "Hope the net pay works." The professional approach says, "Know the net pay before payroll runs." That distinction is one of the most important concepts in payroll planning. Hope is not a strategy. Calculation is a strategy. Professional practitioners do not rely on assumptions when discussing compensation. They use payroll calculations to understand exactly how deductions will affect the final payment. This allows clients and business owners to make informed decisions based on real numbers rather than estimates or guesses. The final message at the bottom of the slide captures the key lesson. Professional payroll planning focuses on what employees actually receive, not what appears on the gross salary line, not what is discussed during planning meetings, but what ultimately reaches the employee's bank account. The key takeaway is simple. Gross pay starts the conversation. Net pay completes the conversation. And professional payroll planning always considers both before making compensation decisions.